In 1971, the United States made a historic decision that would reshape the global financial system. It officially abandoned the gold standard, ending the direct link between the US dollar and gold. This shift, led by President Richard Nixon, has had profound and long-lasting consequences for the world's economic structure. Today, more than half a century later, the ripple effects of this decision are still shaping global markets, inflationary pressures, and international trade. To understand the significance of this move and how it affects us today, we need to explore the historical context and the immediate consequences of the US abandoning the gold standard. We'll examine the reasoning behind the move, the transition to fiat currencies, and how the resulting changes still impact global financial markets and the cost of living for people worldwide. Before we dive into the collapse of the gold standard, let's quickly define what it was. The gold standard was a monetary system in which a country's currency was directly tied to a specific amount of gold. This meant that paper currency could be exchanged for a fixed amount of gold. In essence, gold was the foundation of global currency systems, and the value of money was guaranteed by gold reserves held by central banks. In the early 20th century, many countries, including the United States, adhered to the gold standard. This provided stability to their economies, as the money supply was limited by the amount of gold a country possessed. However, this system had its limitations. During times of war, economic crises, or financial instability, countries struggled to expand the money supply to meet their needs since their currency was limited by gold reserves. The Bretton Woods Agreement, signed in 1944, established a modified version of the gold standard. Under this system, the US dollar became the central global currency, linked to gold at a fixed rate of $35 per ounce. Other currencies were pegged to the dollar, and countries could exchange their currency for dollars, which could then be redeemed for gold. This made the US dollar the cornerstone of global trade, and it remained stable, backed by gold reserves. However, by the late 1960s, the US was facing significant financial pressure. The Vietnam War and domestic spending programs had led to an increase in the US government's budget deficit. To fund these programs, the government printed more money, which was not backed by sufficient gold reserves. As a result, foreign governments, particularly in Europe, began to doubt the ability of the US to maintain the gold standard. In 1971, France, under President Charles de Gaulle, began demanding gold in exchange for its dollar holdings, which triggered a wave of similar actions from other countries. The US could not meet these demands, and President Nixon was forced to take action. On August 15, 1971, Nixon announced the suspension of the US dollar's convertibility into gold. This move, which came to be known as the Nixon shock, effectively ended the Bretton Woods system and the gold standard. Nixon's rationale was simple. The US could no longer afford to exchange its dollars for gold, and the country's increasing trade deficits and inflation were weakening the economy. Nixon's decision marked a dramatic shift in the global monetary system. Without the gold standard to anchor the value of the dollar, the world moved to a system of fiat money, where currencies were no longer tied to a tangible asset. Instead, their value was determined by the trust and confidence of the government that issued them. Following the collapse of the gold standard, the US dollar, along with other major currencies, became fiat currencies. A fiat currency is one that has no intrinsic value and is not backed by a physical commodity like gold or silver. Instead, its value is derived from the trust placed in the issuing government. The transition to fiat currencies allowed governments to print more money as needed without being constrained by gold reserves. This gave them greater flexibility in managing their economies, particularly during times of crisis. However, it also opened the door to inflation and debt accumulation. As the US dollar became the world's reserve currency, global trade increasingly relied on it. Countries around the world began to hold US dollars in their central banks as a store of value and as a medium of exchange for international trade. The petrodollar system, where oil transactions were priced in US dollars, further cemented the dollar's dominance in the global financial system. While the shift to fiat money allowed for greater flexibility in managing economies, it also brought significant risks. The ability of governments to print money without the constraint of gold reserves led to an increase in inflation worldwide. Central banks, especially in the US, began to adopt loose monetary policies, printing money to stimulate economic growth or to finance debt. Inflation, which had been relatively stable during the era of the gold standard, began to rise in the 1970s. The decade was marked by stagflation, a combination of high inflation and high unemployment, particularly in the US. The Federal Reserve's response was to raise interest rates to curb inflation, but this also led to a recession in the early 1980s. Even today, the legacy of inflationary pressures remains a key issue. Central banks, particularly the US Federal Reserve, continue to grapple with balancing economic growth and inflation. The 2008 global financial crisis and the COVID-19 pandemic highlighted the risks of excessive money printing as central banks worldwide expanded the money supply to mitigate the economic fallout. As of today, the global economy is still deeply affected by the shift to fiat currencies. Governments continue to print money, often at an unprecedented rate. The US Federal Reserve, for example, increased the money supply significantly during the COVID-19 pandemic to support the economy. Between 2020 and 2022, the US money supply, M2, grew by 25%, leading to concerns about future inflationary pressures. The continued ability of governments to create money has led to concerns about the long-term stability of fiat currencies. The US dollar, while still the dominant global currency, faces increasing competition from other currencies, such as the euro, the Chinese yuan, and even cryptocurrencies. Some countries are looking to diversify away from the dollar, and central banks are exploring the possibility of digital currencies as a way to maintain control over monetary systems. At the same time, the massive accumulation of debt in many countries, including the US, raises concerns about the sustainability of this system. The more money governments create, the more they must eventually pay back, and the greater the risk of currency debasement. The value of money continues to erode over time, particularly in countries with high levels of debt. In many ways, the abandonment of the gold standard mirrors the historical cycles of currency debasement. Just as the Roman Empire debased its currency by reducing the silver content in its coins, modern economies are experiencing similar pressures. The collapse of Rome's economy was marked by inflation, a loss of confidence in the currency, and the eventual collapse of the empire. Today, we see similar signs of economic instability, with rising debt, currency debasement, and inflation threatening the stability of economies around the world. The collapse of the gold standard set the stage for a new era of economic volatility. As we face mounting global debt and unprecedented levels of money printing, the lessons of the past become increasingly relevant. Understanding the impact of the gold standard's collapse allows us to better navigate the challenges of the modern financial world and anticipate the potential risks and consequences of our current economic path. The end of the gold standard marked a turning point in global economic history. While it provided greater flexibility for governments, it also paved the way for inflation, currency debasement, and global economic instability. Today, we continue to feel the effects of this decision as central banks print money to support their economies and countries struggle to manage debt. The collapse of the gold standard reshaped the world's financial system, and its legacy continues to shape our global economy today. By understanding the history of the gold standard and its collapse, we can better prepare for the economic challenges of the future. The lessons of the past offer valuable insights into the risks of fiat currencies and the importance of maintaining a stable and sustainable monetary system.